if it means nothing, why were the markets up initially and then we've seen a reversal back? Like, I mean, it's been a pretty big sell-off and yields in the dollar are spiking back up. So why is that happening if the CPI was no big deal, right?
Excuse. You got an excuse to trade. That's all it is. It's markets. This is one of the things I enjoyed learning my first day in the trading pits in the 80s when I walked into the Chicago Board of Trade. Is you basically sit there and do nothing all day. Piece of data comes out and everybody moves. It's just a trigger to move. And whether the data is bullish or bearish sometimes doesn't matter. It's just like, okay, so here's what matters. As I'm kind of pointing out here, just a small chart of the Bloomberg's Industrial Metals Index. It's down 15% this year. That's hardly never happens when the stock market's up. And I overlay that with Bitcoin, which is in orange. It's down too. The thing that's the outlier here, which I show you in light gray, is the S&P 500. So the macro is, okay, we're past the data. It's meh. It's kind of PPI and CPI included show the Fed's not going to ease anytime soon. We're heading towards recession. That's kind of a known. The final shoe to drop was the stock market. It's starting to drop. Now, we've already had, I think, a pretty good peak in bond yields and crude oil. Right there, crude oil. We've had the peak, crude oil peaked around 95. US 30-year yield peaked around 5%. And they're starting to tilt towards what I think is this recession that should be kicking in. We shouldn't see the lights of the eyes be end of the Q4. So here's my scenario is what should lead the way down are cryptos. Bitcoin. I published, this is part of what you see in this chart here. In orange is Bitcoin. In white is industrial metals, in gray is the S&P 500. And the leading indicator status of Bitcoin, I think, is still underappreciated. And I like to point out the last few Fed eases were on the back of Bitcoin collapsing first. So to me, there's the macros. We're heading towards that recession. I show you inflation's really high. The Fed's probably done hiking, but there's stuff they can't eat. And the stock market's the most elevated by some measures, at least it was in decades. It's just starting to come back.
So I'm looking at your chart and I see the S&P line is that kind of lighter white one, and then you got Bitcoin, and then so do you think that's kind of like Jaws, right? You think that's going to close with? Do you think that Bitcoin and the metals will go lower, but that the stock market will just come lower faster?
So that's the key thing. That's the $1,000 question. And my answer is I think the stock market's going to decline like it did here. This is a symbol. That's a magenta line, shows recession. Decline for a normal recession, which, yes, everybody's going to say, oh, it's not going to happen. Oh, you said this a year ago. You're too early, of course. But what's happened since then is we hiked rates another 100 basis points this year. And it's just starting to tilt that way. So I think what's going to happen is I believe what's happening with industrial metals, with copper, with the inverted yield curve, and with cryptos, not just Bitcoin. If you look at broad cryptos, they're trading horribly and they bounce, but they're starting to head back down again. And what's happening with liquidity? Liquidity is still negative. M2 money supply is still negative. So to me, this is that tilt towards the stock market's going to go down to its historical relationship, I think, with copper, which is right about the same price. And if I can find that chart, it's that right there. So this is copper and the S&P 500 on the same scale. So I show you in orange, that's the S&P 500, you divide by 1,000. And that's copper in dollars per pound. They trade tick for tick since basically 2015. I don't show you here 2019, but what's significant, what I think fits into your space, since you like to focus on the technicals, is a 200-day average in the S&P 500. It hits that level last week. Remember, it was a quick quiz. Right. It bounced up. You know what happens when markets kiss things like that, and everybody thinks it's okay, you're good, you get the people feel comfortable about being long, and then you stop them out. And to me, that's happening. Copper is signaling it, industrial metals are signaling it, weakness in cryptos are signaling it, and this Fed, that's just, they're jawboning, but these inflation numbers are nowhere near where we're going to have to get for to eat.
The clock is ticking for the United States Securities and Exchange Commission, SEC, to respond to a recent court ruling in favor of Grayscale Investments. The decision compels the SEC to consider Grayscale's application for a spot Bitcoin ETF. By October 13, the SEC must make a critical choice. It can either appeal the D.C. Circuit Court of Appeals decision to the U.S. Supreme Court, request the appeals court to reevaluate its ruling, or proceed with reviewing Grayscale's proposal to transform its Grayscale Bitcoin Trust, GBTC, into a spot Bitcoin ETF. Experts believe that an appeal by the SEC is unlikely. Still, there are other potential roadblocks. The SEC might not deny the proposal outright, but it could find ways to delay the process. The law firm Ropes & Gray has outlined a scenario where the GBTC application is sent back to the SEC for review on different grounds, potentially triggering a new round of appeals. Another potential delay could occur if the New York Stock Exchange has to make a new filing to list GBTC, prolonging the SEC's decision-making process. Notably, multiple spot Bitcoin ETF applications are currently under SEC review. If Grayscale's application is approved, it may set precedent that makes it challenging for the SEC to reject other similar applications. The odds of a spot Bitcoin ETF gaining approval this year stand at 75%, according to Bloomberg analysts. This likelihood increases to 95% by the end of 2024. Despite ongoing delays, the fate of spot Bitcoin ETFs is closely watched, as it may reshape the future of cryptocurrency investment products in the United States. Let's continue our discussion with Gareth.
CPI data comes out this morning slightly. I mean, there were a couple little slightly hotter than expected. PPI, same thing. And I think to what Mike's saying is it tells us higher for longer is in play. But will the Fed actually raise anymore, or you think they're done at this point?
I think they'll raise again. I don't know when they're going to do it, but I think that they'd signal another 0.25 raise. I think that this morning was interesting because it confirmed a similar pattern that we see every time on Crypto Town Hall this morning on my show. It opened, it was up, and I said, I guarantee we end the day down. The first reaction of the markets to these news events is almost always the wrong one. I don't know if that's because of high frequency trading and bots and algorithms, but it takes a while for that news to process. I also think it's sort of a nothing burger, except for that it just reinforces the fact that the Fed is going to keep doing exactly what the Fed has said they're going to keep doing. We talk about the same things every week, but the fact is people are inherently optimistic. The predictive markets tell you all these things that the Fed's going to do, and they've never done them. We have a year and a half now almost of data of everybody predicting the Fed easing or changing their tone or not doing what they're saying, and it just never happens. The Fed's going to continue. They're going to stay higher for longer. We're not seeing cuts anytime soon. And when we do see cuts, by the way, look out below. That's when you have a problem. I literally don't understand how anyone can look at a historical chart and think, great, we're going to pivot and that's going to be good for markets, because they only pivot when things are really bad.
Right, especially with inflation that's now elevated. If they're going to pivot at this point with inflation north of 3%, it's really got to be bad, to your point, right? So do you think that that's like, so one of my big things about the markets is that it seems like there's so many younger people investing ever since COVID, ever since the crypto boom. There's a lot of younger people that honestly, they haven't been through really a recession, right? I mean, they went through COVID, but let's be fair, we were back to all-time highs so quickly. It almost was a false flag, if you will, because it just isn't the reality of situations. I mean, do you think that that's part of the issue here, is that people just haven't experienced it?
100%. Listen, everybody knows the term "don't fight the Fed," but for the majority of investors, that only means one thing to them, which means the Fed will always be quantitatively easing, they'll always be printing more money, and things will only go up. So don't fight the Fed always just meant get long. What they don't realize is that for the last year and a half, don't fight the Fed meant stop buying stuff, don't get long, even get short, because the Fed is telling you they're going to do the opposite. I think that all these younger investors and traders, they're just programmed, as you said, to believe that the Fed is going to ease, things are going to be different, the Fed is lying. The Fed really doesn't lie. Jerome Powell tells you exactly what he's going to do, and he does it. People just choose not to believe him. So yes, I think that, Bitcoin crypto traders, they've only existed in a phase of easy money. This is the first time that we've really seen it during tightening and hawkish policy. And also, I mean, we can get into it another time, but there's also a very major disparity between what the Fed is doing with monetary policy and what the Treasury and such are doing with fiscal policy. So you sort of have these conflicting momentum of one sort of easing by, printing a ton of bonds, and then the other sort of tightening by raising rates. So it's just really a mess, I think. And right now, the easiest thing to do is just take a very, very long-term view and not do anything aggressive.
Banking giant JPMorgan Chase has debuted its blockchain-based collateral settlement system. BlackRock became the first client to use JPMorgan's tokenized collateral network, TCN. The world's largest asset manager used the system to convert shares in one of its money market funds into digital tokens, which had been used as collateral in an over-the-counter derivatives trade with Barclays Pluck. Grocery chain trader Joe's filed a lawsuit this month against the decentralized exchange DEX platform Trader Joe for trademark infringement. The suit, filed in federal court in Los Angeles, alleges that Trader Joe illegally copied the Trader Joe's brand name and seeks to bar the exchange from using the name. If you enjoyed the video, don't forget to give it a thumbs up and subscribe to our channel for more daily updates. Remember, knowledge is power, and we're here to empower you on your financial journey. Until next time, happy investing.